Thank you for joining me. Today I want to go over what are earnings, and the answer is not quite as simple as you may think. So basically we're talking about whichever time frame you choose, let's say year over year. We're looking at the difference in assets versus the previous assets, and liabilities versus the previous liabilities. So we're looking at the current assets minus the past assets, which gives us a growth in assets. And we're talking about the current liabilities minus the previous liabilities to have a growth in liabilities. And then we just take the difference in assets minus the difference in liabilities, and we have the earnings or the loss, as the case may be. So that means that if a company were to raise capital, just go to the bank, create debt, get money, that would not affect their earnings at all currently. If they were to pay off a debt, that would also not affect their earnings because it affects both the assets and the liabilities. If you go to the bank and take a loan, you get money, so you have more money as an asset and you have more debt as a liability. So there's different forms of earnings that are reported. There's before tax earnings, there's after tax earnings, and there's earnings from normal operations, which means that interest payments and all that are taken out of the normal operations earnings. And that is the basics of what earnings or what profit is. And if you like more videos like this, make sure to subscribe. I'm coming out with new videos every day before market open. Have a good day.